from Hampton Studios. I'm Ibn Mabunda. Let's get started. ZSE as well as JSE listed Hwange Colliery today published financials for the 2018 financial year. Well, the coal mine, of course, recorded a loss position of $78.4 million for the year 2018, which is a 79% increase in the loss position from $44 million recorded in 2017. Profit grew, revenue grew 27% to $55 million. However, the negative performance in terms of the profit position was mainly driven by decline in terms of the price of coal as well as the impairment of some of its assets. Company Administrator Mr. Bekitemba Moyo, of course, giving that detail. And of course, the corporation has been through a rough patch, recording a series of losses over the past few years. Resultantly, in October of 2018, the company was placed under judicial management, and of course in November was suspended from the Zimbabwe Stock Exchange as well as the Johannesburg Stock Exchange. Let's just get into the stats so that we get an appreciation of how the corporation has performed over the past few years. So this is their loss position over the past few years. In 2014, they recorded a net loss position of 37.2. 2015, where they reached a loss of $115 million, and there's been that improvement from 2015 to 2017, where they recorded 43.8. But now it seems like their loss position is on a widening path. And if you are to look at how they've performed in terms of their revenue, it's been on an increase pattern from 2016 moving right up to 2018, where they recorded that $69.1 million. On to other items of interest would be, of course, their operational efficiency, right? So this is their working capital position. If you look at how they've performed since 2010, they had, of course, deficit of $21 million, and as you can see from the graph, they've been very much operating in the red. They were only in the black for 2017, where they had a working capital in position which was positive, which was of course $24 million. But then again for 2018, it seems as though the trend is coming back. So in a nutshell, Hwange Colliery has not performed in a satisfactory manner over the past few years, hence the performance that we're actually witnessing at this point. I think several the aspects need to be looked at with regards to how the corporation performs going forward. Meanwhile, ZSE listed cement manufacturer, which is Lafarge, released financials for the 2018 financial year. Revenue scaling 24% to $72 million, driven by price adjustments in the final quarter of 2018. Operating profit of $5.5 million, as well as net profit of $1.3 million. The company bemoaned forex shortages affecting their operations, often resulting in plant outages. Lafarge secured $38.4 million credit funding in 2018, with the greater part being skewed toward operating capital. Again, let's have a look at the stats so that we get an appreciation of how the company has operated over the past few years. Of course, this is a company with a 14% market share with regards to cement manufacture in Zimbabwe. 2014, they recorded a revenue position of $60.4 million. 2015, a revenue position of $61 million. What is also interesting to note here is the fact that they had a profit in 2014 of $100,000, where then in 2015 they recorded a loss there, and things improved. Of course, where revenue actually the revenue is static, but the net loss position seems to actually be widening. And moving to 2017, there's a decline in terms of revenue, but there is an improvement with regards to their loss position. And now in 2018, they have recorded a profit after tax of $1.3 million. That is also in line with a growth in revenue to $72.3 million in that particular regard. Moving on to other business, CBZ Holdings says that they have been, of course, engaged in a particular deal with $100 million for the construction of a Radisson Blue Hotel that we in the capital, site being the Old Waterworld in Eastleigh. Now, what has actually taken place is that with CBZ, they'd engaged foreign investors as well as some local investors in a deal with $100 million, but with the currency devaluation, that has actually affected the progression of that particular project. Meanwhile, CBZ heads for an AGM on the 6th of June for the cancellation of 25% of its issued share capital, being one of the issues that are to be voted on at the particular annual general meeting. If passed, this is expected to, of course, boost CBZ's share values. Meanwhile, Africa's second largest economy, South Africa, heads for presidential polls in 2 days' time. In the previous presidential elections, ANC enjoyed 62% stake of the vote, DA 22%, the ANC 6%, as well as IFP 2.5%. But what is interesting to note is the fact that in the most recent municipal elections, there seems to have been a shake-up with regards to the figures, with the ANC declining to 53.9%, DA gaining to 26.9%, which is almost 27% from 22% in the presidential, as well as EFF gaining from 6% to 8.19%. Now, what then becomes the crucial question is, will the ANC be able to maintain dominance with regards to the elections? Of interest is the fact that there are several issues that need to be resolved, particularly issues to do with state capture, the land reform program, which has, of course, sparked a lot of international interest, without, of course, forgetting the corruption that has embattled the African giant. Well, this concludes our news bulletin. Up next is a focus of the news and news review. Please stay tuned. Welcome back, viewers. It's now time for news review, and with me for a discussion is Chief Analyst here at Equity Access, Respect Gwenzi. Respect, good evening and welcome to the show.
My pleasure. Thank you, Eben. Good evening, viewers.
Beautiful. Let's get the ball rolling. ZSC as well as JSE listed Hwange Colliery releasing financials, and of course, according to the financials, they have posted a loss of $79 million, an increase from $44 million recorded in 2017. What is your comment with regards to the performance that has been posted by Hwange Colliery?
So basically, Hwange is struggling to find its feet. It's been a long time coming. They've really failed to stabilize over a very long time. In 2015, government advanced credit via treasury bills so as to try to reconstruct the organization. Government is also one of the key shareholders in that respective entity. But that money was meant to push up their operations, capacitate them to run their day-to-day business, but it has failed to overturn the loss positions, notably because that money was injected around 2016. So getting into 2017, that's where we're seeing a marginal operating, it's actually a marginal GP gross profit position in that respective year, and a sharp reduction in the loss position. But getting into 2018, the firm changes strategy. They want to get back to produce their own produce. Whereas in 2015 up to 2017, it was the contracted motor engine to do part of their production of coal at their mine. So they have own production, and they also now have got own production and subcontracted production. And if you collect these two, the total should have been ahead of the 150,000 tons that they did for this year. The target was 300,000. So the variance at 150,000 is just too wide. It just shows that there are quite some serious challenges going on at Hwange. And I think this also gives credence to the reconstruction, the new where they were placed under judicial management, the order for placing the entity under judicial management. There's been a lot of mismanagement issues that has been alleged, and there's also been issues to do with shareholder squabbles, with Nick Van Hoog on this end trying to fight towards taking the company in a certain direction. Government on the other end has also been accused of manipulating the entity's day-to-day processes by trying to influence management and picking their own personnel in terms of the non-executive directors. So this has been the case with Hwange for quite a long time now, and by now we should have been seeing fruits of the restructuring exercise that came on board a few years ago. They still prospect and project that they might get back to those 300,000 levels a year in terms of tonnage of coal, but it doesn't seem to be going in that direction. But now that the firm is under reconstruction, I mean, let's wait and see whether this trend of sustained losses can be reversed.
Okay, but what would be the prospects in that regard? Because I mean, if you just have a look at what we have seen here, the mismanagement. Look, even in terms of the working capital, it's a bit of a zigzag there. Even if you look at the current ratio, the liquidity ratio, the outlook, the picture that is actually projected by these figures is not so positive. So with judicial management, how confident are you that we could see changes in that?
Basically, when a company goes under judicial management, the idea is to reform the organization. The idea is to change the whole system. From the basic finance perspective, from a management perspective, you're trying to instill a new culture. You're also trying to recorrect the strategy. You're also trying to stem the leakages. But when you look at Hwange, the complexity of this organization comes from the fact that they have government as a major shareholder. This gives room for manipulation, knowing what we have known about our government. The fact that, they've not been as good in terms of management, in terms of public sector funds management. And this has been one of the ills with Hwange, failure to manage their finances well, and also trying to line pockets along the way in terms of management. But when you look at these key metrics or key indicators, they really show a company which is in distress, from negative operational efficiencies, working capital, current ratio, and liquidity ratios as well. If you have a negative working capital position and a negative liquidity ratio, the implication is that you are not able to even fund your operations. You are not able to, because one of the major things that Hwange faces is that it has failed to attract good prices for its coal. And obviously that means less in terms of realizable income. And they've also had higher costs due to the fact that coal is mainly transported through rail. In the case of the present day scenario is the NRZ's rail has not been covering as much ground in Zim as it used to be back then. So if you are moving your produce by road, it inflates the cost of transportation. So that basically also increases their prices, and they've not also been able to tame part of the electricity issues in Hwange, and all those things have led to an increase in their operating costs, including a bloated workforce as well. Government has stopped them from retrenching some of the excess workforce there. So it's quite a complex scenario, but I believe with such matrices which are in the negative, it's very difficult to turn around the operation. But let's wait to see. Reconstruction comes with a change along most of these matrices, be it financial and management side. So maybe government is up to something, but some of the shareholders are against the move, and we really wait to see. But I don't believe that as long as government is controlling. In fact, I believe that if government retains manipulation and control of this entity, it might fail to achieve the desired objectives of increased performance or better performance in the years to come.
I realize. Now, still on the reporting note, Lafarge they released their financials, of course. I mean, they recently ended financial reporting galore, and quite a positive performance. The revenue scaling 24% to $72 million, operating profit of $5.5 million. What is your comment with regards to how the corporation has actually performed? Notably is how they've actually improved in terms of their profit after tax, coming from a net loss position of $0.6 million, and now they're sitting at $1.3 million.
My basic conclusion around this performance is that it's quite mixed. We have a top line which is growing, and we also have a bottom line which is also growing. But I want us to dissect a bit in terms of how they came to achieve this performance. The growth in the top line, it's basically a historical high. They've never done anything of that sort right at the top. But there are two things which happened here. We're seeing price recovery in the last quarter of the year. This is mainly a result of inflation, and they were forced to adjust their prices in line with the market. But on the other hand, we are seeing a volumes loss. They lost a significant portion of volumes due to plant outages. There were periods where they were failed to produce because their plant was down. The plant was down also because they failed to access forex to import spare parts, as well as other additionals that were needed on the respective plant, inputs that were supposed to be used for production. So those are the key drivers of constrained top line growth. We are seeing a top line growth there of about 24% against inflation of 46%. And that really shows you the variance and possibly the implication of a volumes drag. And when you look at operating and PAT, those basically took in. But then you also see a constrained margin, because that's about the basic GP margins. They're coming in at 7%. I don't believe that a cement manufacturing company has to report GP margins of such low magnitude at 7%. If you look at other companies, look at Dangote, and you look at other Kenyan operations, you realize that their GP margins are quite way ahead. And one other key metric when it comes to valuation, which is not basically a performance indicator, but rather what it shows in terms of where the company should be valued at. If you look at a company which has got a price earnings of about 100 compared to an industry average of just about 16%, that just shows you that the performance, or in fact the price at which this counter is trading at in Zimbabwe is grossly overvalued. Why? Because other companies are being bought at 15 times their price, whereas this company is being bought at 100 times its own price. So what does it mean? It means on the stock market we might see a loss in price of that respective counter. If you look at issues like return on equity and return on assets, this is way below 3 and 1%, 3% in terms of return on equity. This is the money. Or the return factor which shareholders who would have put in their money are getting back in terms of profitability. So profitability is a measure of what you would have put into the company as an investment. They're only returning 3%, of which the average market return is just close to about 7 thereabout. If you check on the one, the Dangote one, and Bamburi, and you do an average against the 5, you find an average of, over 10%. So they are returning less to their shareholders, and also they are overvalued in terms of the price earnings. So all those matrices point to a company that's struggling. But if you want to look a bit into how this company has emerged over the years. This used to be a very good company. I think around 2014, they used to be one of the jewels of the Zimbabwe Stock Exchange. But I believe that when PPC chose to strategically move their assets and come close to the Harare market, which is the key market when it comes to construction in Zim, it really changed the matrix around cement, the cement sector in Zim. So we had PPC coming on board in Harare, and they had to put a plant which produces more than 700,000 tons of cement per year, bringing in the total capacity to about 1.4. Looking at PPC, looking at Lafarge, they have a plant in Harare which produces 400,000 tons. And there came another player who came in with 400,000 tons as well. So there is PPC, there is the third player, and these are close to the market, to the Harare market. And they're now competing in a tough way. Lafarge has been the only player and the only dominant player in Harare. So it brought in a lot of shifts. And when you look at the plant capacity, if you look at the technology in terms of the milling plants, you'd find that theirs is a bit slower than the ones that have been put in place by Lafarge and the other competitor guys. So this whole thing changed the matrix of the cement market in Zimbabwe. Not to say that there's been a slow, in fact, demand has been firm. In recent years, we have seen a lot of construction work going on. Housing sector has been booming, notably against the background of a serious housing backlog in Zimbabwe at an estimated 1.3 million houses. So this has really brought the cement players into a point of excess competition in a booming market like especially Harare, which consumes over 70% of all the cement in this country. So Lafarge has really struggled to find its own way in the market, and they've changed management, trying to counter, trying to bring in new strategies. But I think they've also been getting it wrong. Most of these guys are not as conversant with the market, that they don't know the dynamics around the Zim market. One key thing here, if you have PPC as a player which is producing excess cement, they have been quick enough to realize that you need to export this cement in order for you to get Forex to cover some of your Forex demands. So they've been quick to push in the export into the export market. Lafarge has been slow. Lately, that's their strategy now, to refocus on the regional market. But it might be too late. But still, I think now that they've secured some funding, which they've committed to some planned upgrades, it might mean that they are coming back stronger in 2019. But they have been slow, and I believe they can do better given the background.
Fantastic. Now moving on to CBZ Holdings. They were one of the key issues there where CBZ is concerned is they're heading for an AGM on the 6th of June, where there's on the table a proposal to cancel 25% of the issued share capital. Would you want to shed more light where that is concerned?
So the proposal is against Treasury Shares. Treasury Shares work in such a way that an entity is allowed to issue a certain magnitude of shares. That is when it goes public. So you might have an issued share capital which is coming from your allowed share capital base. So you have issued share capital, which is what you have already issued, against a certain base which is authorized. So there's authorized share capital, and then there's issued share capital. So within your issued share capital, which is what you have issued, you can also choose to buy back and hold certain shares. So when you buy back and hold these shares, you put them in treasury. They're now recorded as treasury shares. These are held for strategic purposes. This can be issued as and when necessary, or as and when you might want to get a strategic partner. Like, for instance, in about 9 or 10 years back, or even more, CBZ went into a strategic partnership with the Libyan bank. Of course, Gaddafi issues and whatnot. But these are instances where you might strategically push out shares from the treasury side and issue them to some other potential, to some other investor, strategic investor. But in this instance, I want to believe that CBZ has suffered from one thing over the years. They have failed to realize maximum value on the market. Why? It has always been subjective, but I believe the market perceives that the proximity of the bank to the government is negative, or it's a risk to the bank. So they discount by a huge factor whatever matrices they are to value a company. So government, of course, they control not as much a significant shareholding, but they have also been borrowing more from that entity at individual levels and also at government levels. So this has actually resulted in the investment or the investor side choosing to discount more in terms of the real value. So they believe that if CBZ has got an NPL ratio of 5%, maybe the true reflection is 10%, because cronies and government bosses, they might not be paying. I mean, that's the negative, that's the perception out there. So in trying to address the variance between the market price and the envisaged value which CBZ believes they have, you can actually do so by buying back your own shares. If you buy back your own shares, you increase the value of your company in a way through some valuation matrices. So I want to believe this might be one of those issues. So if you buy back and you terminate, it means you have constrained your issued share capital. When somebody is calculating value, they use shares in issue and the price at stake. So if the shares become constrained, other valuation matrices go up. So it might be to address such, and that's what I believe. And then coming into the issue to do with CBZ's delayed
$100 million deal there with.
Yes, so this is an interesting subject. Why? Because it comes at a time where the economy is facing a lot of challenges and headwinds in terms of our decision to get back to re-dollarize, in fact, to de-dollarize. This is what we have effectively done on paper. Investors are in a wait and see attitude. They're right on the sidelines. They're waiting to really have a clear view of where the economy is going, whether we can be able to sustain the move that we have played so far. But also there are issues to do with foreign currency. Are we able to commit to having a viable interbank market? If somebody brings in their money, would they get a fair value of their money? And would they even get their money in the first place? So all those issues, they can only be looked at by giving yourself time. So zooming in on this specific $100 million deal, it had 3 players involved: CBZ, Radisson, and the third player. And these guys were all supposed to bring in a bit of seed capital in terms of the other one in Forex, the other one in... But when the deal consummated, every money was denoted as Forex in the first place. But now that there's been a shift in the dynamics of the economy in terms of currencies, it means somebody is going to bring in RTGS, the other one is going to bring in USD. And so it definitely brought in some bit of challenges into how the deal could be moved forward. But quite significantly, this is FDI, which was supposed to come into the country, foreign direct investment that was supposed to come into the country. And given this delay, it actually means we've lost in terms of potential FDI. And this is the challenge that we are having in Zim. We are not able to quantify or to really see what we are losing by pursuing some policies which are not as consistent. By swaying along the way, we are tending to lose potential investment. So this is where we have come to. CBZ has failed to move through the deal, not because of their own shortfalls, but because of government's policy and some of the things that are pursuing as a nation. And these losses might be amplified also. If you look at it from a general perspective, we might be losing more in terms of this potential FDI due to this.
Potentially billions, because I'm saying this is a $100 million deal. There are other smaller deals. I know of a certain deal with one financial institution with $6 million in a solar project, in the which the Hwange was supposed to invest $6 million, but now because they couldn't access the $6 million from the RBZ in terms of the forex, they then actually could not sail through. So what ended up happening was you had the startup actually engaging a Kenyan investor to get into business with them. So I think that we need to look at what kind of policies we put in place and stick to them. Firstly, implement sound policies that we're able to follow through and actually come up with positives so as to allow for foreign direct investment in the country. Then skipping Limpopo, getting on to Mzansi, they've got the elections in 2 days' time. What do you think we could expect from the elections, as well as how much of an impact would the elections be with regards to the economy?
I think South Africa is a very important economy and a very important country to Africa specifically. This is the most industrialized nation in Africa, It is also it is also the second largest in terms of economic size. That's the size of their GDP. It is also a mature democracy, if I may say. They're quite young in terms of the period between their independence and now, but they're quite significant in that they've been able to allow for freedoms to take place in their country. But now, looking at what could potentially play out, I think this is a very important election for South Africa and basically for Africa in general. If the ANC wins, which is most likely in this case, they are going to possibly, obviously, move forward with land expropriation without compensation, which has already taken effect anyway. They are also likely to dig deeper into issues to do with corruption. I'm sure viewers are aware of the state capture which dominated SA in 2018 and now getting into 2019 as well. These are things that have affected the economy. Investors are now scaring away from the economy, and there's also a lot of uncertainties around the land issue. But we're likely to see the EFF, which is led by Malema, deepening itself and obviously increasing its appeal to the populace. Why? Because they've been driving the national agenda. This aspect of land expropriation without compensation is really a brainchild of Malema, which he copied from the Zim government. He idolizes the former president Robert Mugabe, and so we're likely to see him gaining turf in terms of magnitude of his. I mean, the percentage that is likely to get, I'm seeing it move at a much faster rate than both the effect, but than the DA, because I expect obviously the ANC's own tally to come off a bit to levels just above the 50% from 62. If this comes to play, I think that positions South Africa as a state which might be ready to transition into having a secondary political party taking over power, because at those levels anyone can easily take power. Why? Because it's just above the margin, and you might even go below in successive elections. So I think that this is something that we need in Africa. We don't need very strong political parties. We need political parties which can give each other a chance. I mean, one wins and the other takes over the other time, and so forth and so forth. That's how you deepen democracy, like in States or in Australia or in UK. There's always this interchange between the Tories and Labour, or between the Democrats and the Republicans and so forth. So I think we haven't matured. Most of the African states are ruled by liberation movements, and most of these are too relaxed, corrupt, and whatnot. And this has been evident even in our own country. So I believe South Africa can graduate and show us the way. But it will be quite an interesting election to look forward to. It's gonna bring in some seismic shifts in the African way of doing things, and we really look forward to that result.
And the EFF continues to promise free education, and looks like university students are catching on to the wave. Let's see how the story actually develops there.
Yeah, sure. I mean, the populist wave is right across the world. If you look at the states itself, the win by Donald Trump, and of course in Netherlands as well, and obviously in Europe as well. I think one of the countries should be Italy. It's won by a populist. It was won by a populist leader, and the influence around the Brexit as well. Nigel Farage leading the Brexit process. These are nationalist sentiments, people who are looking inwards and obviously pushing in such rhetoric. But I believe it's also detrimental for growth, because once you promise free education, you have to fund it. If you look well into the issue to do with Venezuela, these were some of the policies that were pursued by Chavez before he gave in for Maduro, and these are the policies which drag the economy into what it is today. So some of these things need to be relooked at, and to see how viable it is to pursue such policies. But of course, in election time, it's called political banter, and obviously people catch on to it. But further substance might need to be dig in.
Well, interesting discussion right there, Respect. Thank you. Viewers, please stay tuned. Up next is a focus on the stock markets. Welcome back, viewers. It's now time for Markets Daily, and joining me in set is Anesu Chumbum, one of our very own investments analysts. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Fantastic. Yourself?
I'm alright. How's been the weekend?
Won't complain.
That's good. Well, let's just get on to it. It's now 6 weeks running with the market on a rally. For the industrials index, it did add about 0.38% today, for it to settle 455.1 points, while the minings index did join that set of risers today, coming up 0.21% to settle at 185.3 points. Econet did have the large chunk of the risers set today, coming up 3.84%, pretty much to push up the ZEC top 10 index to about 0.12% increase to 129.7 points. Now, this marginal increase by the top 10 index is pretty much consequent to a 1.86% drop and 0.72% drop in both Padenga and Old Mutual. Adding to that was Delta, that led up 1.77% for that minings index to settle. For the top 10 index to only marginally increase. We are talking about a market that has been coming up 6 weeks straight. Such strides have managed to reduce some of the year-to-date losses that we experienced. For example, as of Friday, all share index was only down 7.21%, coming from a 21% loss in a fortnight ago. The all-share index, however, has shown some strong dominance today, coming up 3.69% on a week-to-date basis, for it to settle at 136.2, while the top 10 index is only up 3.5%. Now, for our risers and fallers, as of on a year-to-date basis, we are looking at about 30 counters that have risen since the year began on a year-to-date basis versus 21 counters that are on the negative. Now, among for the counters that rose today, Medtech and RTG did lead the pack of 10 bulls, coming out 28.57% and 19.64% for RTG and Medtech to settle 3.35 cents and 0.18 cents. On the other end of the yardstick, four counters were laggards today, Axia being the weakest performing counter, after having led up about 2.3% for it to settle at 36.15 cents. Padenga did settle at 112.22 cents to 1.86 because of dropping about 1.86% on its prior session's share price. Just to move on quickly to our interbank market, so we can wrap up the show very quickly today, with the interbank market weakening to a 32% decline from its promulgation on the 22nd of February. It is now trading at $3.29 RTGS dollar per US dollar, while the old mutual implied rate has pretty much come off to settle at to trade at about 5.02 RTGS dollars for the dollar. And the parallel market did appreciate today, coming up to 4.9. Sorry, did depreciate to 4.9 outages dollars per dollar. Now, this trend is expected to continue. Some of this trend has shown a little bit of cracks within the macroeconomic factors that have pretty much pushed our stock market investors into a risk-averse mentality, where they have put themselves in the stock market and found it to be a safe haven, which has pretty much caused for the stock market to pretty much be overvalued at the current moment. A lot of inflationary hedging coming into play there. Now, inflationary hedging has also somewhat play in the forex market because of how goods and services are being priced at the current moment. A lot of retailers are pricing goods first in US dollar and then converting it to a desired rate of their own choice, whether it be the payroll market rate, old mutual employed rate, or the interbank rate, depending on how formal they would want to address themselves.
Well, thank you, Anesu, for the insight. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From the Equity Access team and I, Danke, and good evening. A splendid evening it is to you, viewers. Thank you for joining us right on Equity Access.